Thank you for joining us today. Feel free, if you have any questions or comments following this webinar, feel free to contact me directly at LEVIN, M for Mike, at ILSOY.org. And with that, I will turn it over to our speakers. Thank you.
Wonderful. And thank you, Mike, so much. And thank you to the Illinois Soybean Association for the opportunity to be here today. And I will just echo what Mike just said on the importance of advocacy and the role that Illinois soybean plays. It's so critically important that you have representation on these key issues. There is no stronger political force in America than U.S. agriculture, but only if we work together and channel our interests in the right directions. And Illinois Soybean and other associations like Illinois Soybean just play such a critical role in making sure that people understand what our needs are and that those needs are heard on the Hill. So kudos to Mike and the team at Illinois Soybean for the great work that they do. I'm going to talk a little bit about KCoe Isom and who we are as a company and the services we provide. I'm going to cover a little bit of election prognostication. I want to just show you some graphs that I've pulled together in terms of tracking polling in some of the key battleground states in the Midwest. And then we'll talk briefly about some policy issues that should be on your radar before turning to Kevin, who will give the meat of the presentation in terms of tax and what to expect on the tax front. So with that, let me see if I can share my screen and get things rolling. And I'm going to, hopefully, let's see if this will work. There we go. So let me just click through some slides. I have a number. Feel free to ask questions at the end of the presentation. And again, we'll do a Q&A after Kevin talks. So happy to dive into details on any of this. Again, you've already been introduced to me and Kevin. Within KCoe Isom, I play a number of roles. I coordinate our lobbying. That can be direct lobbying on behalf of clients. So we have clients who want to see individual changes in the tax code or are having problems on a regulatory front with the federal agency. We'll help them in that way. I'll talk a little bit also about some of the large campaigns that we run coordinating across U.S. agriculture. So I wear a number of hats within the government and public affairs world for KCoe Isom and our clients. Kevin, as Mike already mentioned, tax attorney specializing in estate planning. So who is KCoe Isom? KCoe Isom, and it's a bit of a mouthful, but let me introduce you to the firm if you haven't already met us. We were formed 80 plus years ago, originally in Kansas as a CPA firm. And over the past 80 years, KCoe Isom has grown throughout the United States. We now have 30 plus offices around the US. Basically anywhere you find US agriculture, you'll find KCoe Isom. We are working integrally with farmers, with food processors throughout the food and ag supply chain. And we've really decided early on that our role really is not so much a CPA firm as an ag firm. That's where we want to make the difference and be industry leaders. And so we've been moving intentionally in that way, like I said, for quite some time. We think about our role as being providing services from policy to plate. So really, and this starts with the presentation I'm giving, we think it's very important that farmers not be reactive. What you don't want to do, whether it's tax planning or succession planning or business planning or financial planning, whatever you're going through, what you don't want to do is be in reactive mode where you're saying, oh, something's happening to me, I need to react. How can I not get hurt, or how can I benefit? Much better is to try to start earlier with the influence. How do we want to shape political systems and policy systems? How do we want to shape our business practices early so that we're ahead of the curve and that we can get competitive advantages? So we really, when we talk about from policy to plate, we try to start the conversation earlier than a lot of firms would, not just advising you on what the law is, but really trying to think about what the law should be. We then focus on resources. How do we make sure we have the resources and that our clients have the resources necessary to grow and prosper? And that we have an arm that's KCoe Capital that helps with capital raising, an ag lending practice, a focus on crop insurance, and ag knowledge, which is a really great part of KCoe Isom. Ag knowledge focuses on helping farmers professionalize their financial data, get the receipts out of shoe boxes and into QuickBooks, and really professionalize operations so that they can move on to the next level of success. Focusing on production, we have a full ag practice that focuses on everything from commodity and specialty crops, animal agriculture, very heavy, for example, throughout the beef sector, food and beverages, and then also biofuels, very robust ethanol practice, working with ethanol producers and biodiesel producers. Then the marketplace, focusing forward, not just at production agriculture, but how do we get our products to market and really help with sales? So transportation and distribution, storage, working directly with grocers, working with food processors, all of these things to try to make sure that we're thinking holistically about a food supply chain, not just about producer level. And that gets us to the plate, really thinking about these holistic systems that get us from influencing policy to the food ending up on the plate, whether that's in the United States or whether that's with exports to China and other countries. Thinking about things like sustainability and consumer interests so that we make sure that our clients are able to produce the products that consumers want in the way that consumers want. So really thinking holistically about these issues. So here are some of the specific services that KCoe Isom provides. I think one of the things that you'll see is that we are not your typical CPA firm. We do provide CPA services, whether that's accounting, tax and audit services, that whole robust practice, really the best in America. But we've gone well beyond that to provide wraparound consulting services for our clients, everything from consulting on animal care, sustainability planning, to environmental markets, figuring out how to participate in nutrient trading programs, grain and livestock marketing, next generation planning, really focusing on how to make sure that farm operations can be passed on to the next generation with minimal tax consequences and with the right structures for your family. And then ag association services I wanted to mention in particular because this webinar is being hosted with Illinois Soybean. One of the things KCoe Isom does a lot of times behind the scenes is help coordinate national campaigns. So this is an example, this Ag Talk series. We coordinated this over the course of the summer for a broad coalition of ag associations. So Iowa Soybean, American Soybean was a member of this effort, National Corn Growers, National Milk Producers, Corn Refiners Association. And we hosted a series of 5 virtual town halls, Iowa, Michigan, Pennsylvania, Wisconsin, and Minnesota, talking specifically about international trade and supply chains. KCoe Isom coordinated that effort. We were also sponsors of it, but we weren't front and center. It was framed up as an Ag Talk series on behalf of the ag associations that we work with. So that's some of the kind of behind the scenes work we're doing to try to advance the interests of American agriculture. Yeah, I'm going to shift gears a little bit. I want to talk a little bit about the election update and forecast, because obviously we have an election right around the corner on Tuesday. Hopefully you have all either already voted or made plans to go vote on Tuesday. Critically important that agriculture show up and vote. This election should not be surprising to you, will be a close election. And it's hard to say which way it will break. I really think at this point you could see a Biden presidency or a Trump presidency. You could see a Republican Senate or a Democratic Senate. Odds are you're going to see a Democratic House. I doubt that will shift. But the Senate and the White House are both hanging by a thread. Could go either way depending on some of these key battleground states. I'm going to show you a series of slides that I've put together just to try to track this election and what it means, try to separate some of the wheat from the chaff. And what you see here and what you'll see in the next series of slides are days out from the election, 2016 and 2020. So the blue line on each slide is Hillary Clinton, where she was polling on the website 538. So they put together a composite score. And these are days out from the election. The line above that, the orange line, is Biden and where he is polling, the same number of days out from the election. One thing you'll also note is at the very end, that steep drop off in this graph and in the subsequent graphs is the difference between where 538 pegged the poll and where the actual election outcome came in. And recall, for most of these states, the election results were better for Trump and worse for Clinton. There was a late break momentum for President Trump in 2016, and that really carried through to election day. So you see that drop off, and you'll see that in all these slides. So this is a national comparison. Biden fairly consistently has been running ahead of Hillary Clinton in the national polls by a pretty significant margin, 2 to 4 points, depending on the poll in the day, which is a significant increase. So I think at this point, we should expect that Biden will win the popular vote. Of course, the president is not picked on popular vote, it's picked on electoral college. So I'm going to show you some of the key electoral college states. This is the Minnesota comparison. Recall that Hillary Clinton won Minnesota. That's why, even though you see such a large drop off in the blue line, it still ends up above 0. So she narrowly won Minnesota. In the polling today, Biden is again running ahead of Hillary Clinton's record. So even if you saw a comparable drop off, I think we should expect that Biden will probably hold Minnesota given this data at this point. Wisconsin, same kind of story for quite a while. For the last 30 days, Biden and Hillary were running about the same in Wisconsin. Recent polling, really since the first debate, Biden has pulled ahead pretty considerably from where Hillary Clinton was running. Wisconsin came down to a very small number of votes at the end of the day. I think between Wisconsin, Pennsylvania, and Michigan, those 3 states, the total vote difference in 2016 was 70,000 votes. So when you realize, we're talking millions and millions of votes cast, a 70,000 vote difference decided who won Wisconsin, Michigan, and Pennsylvania. So very razor thin margins. And at this point, Biden is on track probably to win Wisconsin. He's running ahead, but there's a lot of unknowns at this point, not the least of which is obviously pandemic, mail-in voting, whether mail-in votes will be counted, and if so, how many. All of that could skew so that you're not really seeing a poll result, but how many votes are legally counted, I think is really going to be the election night determination. Pennsylvania, much closer. Again, Biden just in the last week has been running slightly ahead of Hillary Clinton, but really on track. And Pennsylvania was one of those 3 states that composite was about 70,000 votes. So I think Pennsylvania is the state to watch on election night, and it probably will not be decided on election night. I would expect Pennsylvania will stay open as a discussion for at least a week. Michigan, Biden is running well ahead of Hillary's track. And one of the interesting things about this graph is to see where Hillary Clinton's trend was headed. You can really see that momentum that was shaping up in the final days of the 2016 election in terms of her downward slide of polling. And you're not seeing that same kind of momentum reflected in the polls from Michigan. So let me just summarize by saying, there are a number of outcomes that we could expect on election night for the presidential. One is a clear Trump victory, one is a clear Biden victory, and one is uncertainty. A clear Biden victory, I think we would see if Biden wins one of the unexpected states. If you see Biden win Georgia, Florida, Texas, North Carolina, pretty good bet that very quickly the election will be called for Biden. Pretty clear Trump victory would be if Trump wins one of the must-win states for him to reach 270, and that again I think would be Pennsylvania. If you see Pennsylvania called for Trump, it's going to be a good night. Other early indicators would be Virginia. Right now Biden's running way ahead, but if you see Virginia trend toward Trump, that's going to be one of the early vote returns, so that would be one to watch. Same with Florida. If Florida is not a 1-point race, if Trump really opens up the floodgates and is 3 points up in Florida, expect it to be a very good night for Trump. Again, a number of scenarios that could lead us to a stalemate that could last days or even weeks in terms of who the president is. On the Senate side, expect a very close horse race. The Democrats, I think, are poised to pick up seats, but whether they can pick up enough to get the majority in the Senate is a really critical question. Let me just touch briefly on a couple of policy issues before handing the microphone over to Kevin. Critical issues for ag in the Midwest. One is ethanol and biodiesel policies. That's obviously been a really big issue over the last 4 years with the ethanol waivers that President Trump issued. More recently, he's been denying those waivers to the small refineries. But there are a number of other issues that are on the table, relabeling of pumps, and a number of obviously tax issues related to ethanol and biodiesel. Right now, former Vice President Biden has said good things on ethanol. He said that he supports ethanol and E15 expansion. So hopefully we would not see a significant difference. Hopefully we would not see small refinery waivers like we did over the last 4 years, but I think that is one of the key issues to watch. Trade updates, obviously critical issues for ag has been the direction of international trade over the last 4 years between China, USMCA, Canada, and Mexico, EU trade. A lot of work to do whether you see a President Biden or a President Trump. Either way, I think we in the ag community need to put our weight on the line to say, look, we need to get these markets open. We need to get exports increasing. And really, that's the bread and butter for soybeans and for corn, as you guys know better than anyone else. Farm Service Agency rule I wanted to mention just briefly. This is probably not on your radar screen yet, but it should be. KCoe Isom sent a letter to Secretary Perdue this week asking Sonny Perdue to withdraw a recent USDA rule. USDA issued a rule in August that changes the way farm payment program eligibility is determined. They issued this rule without any public input. They didn't have a notice and comment period on the rule. And they really kind of screwed the rule up. One of the things they changed was how you assess eligibility with respect to management. To date, before this rule, you could be eligible for a farm service payment as an individual for calculation purposes if your percent of management was commensurate with your ownership in the operation. So if you had a 5% ownership stake in an operation and did more or less 5% of management, you could be eligible in that calculation. The new rule says in order to be eligible as a manager, you have to either put in 500 hours of management time each year or 25% of the management of the operation. That's a big shift and a real problem because that obviously means the most individuals you could use for calculating on a management basis would be 4 if each has to have 25% of the management share. So if you have a son or a daughter who's in college, it's harder for them to qualify. If you have a parent or a grandparent who maybe is doing a little bit of work around the farm but not so actively engaged, it will be harder for them to qualify. So we've asked the Farm Services Agency to withdraw that rule. You can find more information about that on our website, but that's one that you should be aware of and track as you think about farm payments in the coming year. And then finally, CARES Act, I wanted to mention the stimulus bills. We all know there have been a number of payments out to farmers under the Commodity Credit Corporation, as well as things like the Paycheck Protection Rules or funding program. That program, I think the key takeaway here is Congress did not get its next stimulus bill done. We expect that we will see another stimulus bill in the lame duck session of Congress. That's one thing we're tracking very carefully. So I would expect in November, December, we will see another stimulus bill that may include additional funding for agriculture. I would put that at probably an 80% chance of happening in November and December. And then finally, and I'll pass to Kevin, we want to talk about tax. I think 2 things that I want to flag before handing it to Kevin. One is, I think we should all be eyes wide open that whatever happens in the election of 2020, we will see tax reform or tax code changes coming in 2021, 2022, 2023. Why do I think that? I think it's just a matter of looking at the debt and the budget deficit. America has really spent like a drunken sailor over the last 5 years. You think about the tax reform of a number of years ago that had a multi-trillion-dollar tax revenue hit. And then you think more recently with stimulus. I mean, we've thrown $2 trillion out the door. We've thrown $1 trillion out the door. Now we're talking about another stimulus package that could be 1 to 1.5 trillion. And on top of that, we've had an increase in spending on a lot of discretionary accounts. So I think it's pretty rational to think that given the deficit, given the debt, we are going to see an effort to tighten the belt. We're going to have to. The bill will come due. And I think that will be reflected both in efforts to rein in spending and to increase revenues. So I think regardless of who wins, who controls the Senate, expect that the tax code will continue to change, and some of that will probably end up on the shoulders of farmers. So with that, let me pass the microphone to Kevin Bailey. I'll stop sharing my screen. And Kevin, why don't you talk to us a little bit about what we expect to see in tax code changes, and specifically with estate planning.
Thank you, Brian. Good afternoon, everybody. Thank you for taking the time. I know you're all busy. Hopefully you see the end in sight with harvest and with the presidential and election ads also. I know I've been sick of those for probably 3 months. So I think we're all ready to see harvest come to an end, and we're all ready to see the ads that they're running on TV come to an end. Brian's right. I have bad news and good news. And the bad news is taxes are going up. I don't see any way that even if the Republicans maintain the Senate and the presidency, the taxes are going to have to go up just because we're running a deficit that is quite out of control right now. And I don't see a path where the Democrats don't control the House, which means they will be introducing tax bills all the time in order to increase the taxes. But I can't see a scenario in the presidency, the Senate, or the House where taxing doesn't go up in some regard. And so we'll talk about what those different policies may be based upon the likely outcome of the election. But first, I want to give a little history of how we even got to where we're at, especially with estate taxes. So estate taxes came into effect in 1916, in essence, to pay for World War I. And World War I has been over for exactly 100 years now, actually 102. So the estate tax system stayed around because it really came in on the heels of the income tax system that we currently have. The estate tax system was developed and based upon an exemption amount. And back then it was $50,000 in 1916, meaning every individual could pass away with up to $50,000 of assets before they were taxed at a 55% tax rate on those assets. That $50,000 was created based upon about 12 times the average household income. So we're going to talk a little bit about why the Democrats and the Republicans may have different philosophies about what the estate tax law should be. The estate tax exemption amount stayed at $50,000 for 50 years. It wasn't increased until 1976, when the federal government also created the gift tax system. So you say, my, $50,000, everybody was paying estate taxes, right? Well, no, because there was no gift tax system. So up until 1976, you just gave away all your assets before you passed away, either by will, trust, or inheritance, and you didn't pay estate tax. So it was pretty easy to get around the estate tax rules, laws, up until 1976, when they kind of married the gift tax and the estate tax system together. And then they slowly started creeping up the exemption amount. So we saw that exemption start increasing in 1976. In small increments. I mean, for most of us that remember, if we had parents that passed away in the 90s, the exemptions amounts were still $600,000-$700,000. So it got pretty difficult to do some planning around that. Well, it was in 1996 that the Republicans really started embracing the idea of doing away with estate tax. Because as we had run-ups in the stock market in the 80s, and then again in the mid 90s and in the late 90s, as the stock market started running up, all of a sudden you started seeing more and more people becoming subject to the estate tax system. Quite honestly, it just didn't catch that many people early on. And so people didn't give it a lot of thought. It's still a small percentage of people that pay estate tax or even are subject to the estate tax, but it has certainly become much more of a political football starting in the 2000s, right in 2000, and it will continue to be. That's also bad news. The estate tax system is going to continue to be a political football for the two parties. But it was really in 2000 when President Bush, 43, embraced the idea of doing away with the estate tax system and just having no estate tax system. Well, the Democrats quite honestly believe that our forefathers wanted an estate tax system because they didn't want a European system where the same 10 families could inherit all the property of this country as they did in Europe. So the Democrats kind of embraced an estate tax system where more based on meritocracy and from generation to generation, you had to prove yourself by paying this wealth tax or estate tax and just couldn't pass it on from generation to generation. So we had this real headbutting that really started occurring in the late 90s, 1990s, and then the early 2000s. The Republicans certainly have pushed to eliminate the estate tax, but several times in the last 20 years, they have had the votes to do it and have elected not to vote to remove the estate tax system. The first time was in 2005 when they clearly had the 60 votes that they needed in the Senate in order to overturn the estate tax system. And then the weekend they were scheduled to vote, Katrina hit New Orleans and went up through the southern states and caused a lot of damage. The government knew it was going to have to pay for that. And so they decided not to even bring that vote to the floor. Certainly back in 2016, when the Republicans won the House, the Senate, and the White House, as they were drafting this new tax law that came into effect in 17, they certainly considered and talked quite a bit about repealing the estate tax system, and quite honestly had the votes, because if we all remember, they changed the rules in 17. The Republican Senate changed the rules because it always took 60 votes in order to adopt a tax system or a tax code or to change the tax code. Well, the Republicans changed those rules to say it only took a simple majority of 51 votes in order to change the tax rules. They had 51 votes and they were able to change the tax rules. So they could have eliminated the estate tax at that point in time. It wouldn't have been permanent because, again, with the way our budget system is set up, you can't be running deficits after 10 years to a certain percentage. And so that's why a lot of the provisions in the 2017 Tax Act that we now have used are not permanent. They will switch and go back in 2026. Some of them are even earlier, but most of them revert back to the old rules in 2026. So most of the tax rules that were set up under those tax laws in 2017 are going to revert, and that includes the estate tax. It is going back. So the current estate tax, based upon that law that came into effect in 17, allows each one of us about $11.5 million of taxable assets in our estate that we can either die with or give away during our lifetime. So you have $11.5 million that you can either pass away with or give during your lifetime before the estate tax system kicks in, and those assets in excess of that are subject to a 40% tax. So for those on the call this morning and this afternoon that already are in excess of that exemption, you're working just as hard for the federal government as for any of your other partners, because any dollar you grow over that exemption amount, 40% of it will go to the IRS. And 40% is actually historically low for an estate tax rate. It was 55% for most of our history up until the early 2000s, when, if anybody remembers the early 2000s, that tax rate was changing almost annually, and so was the exemption. It was made permanent at 40% under President Obama, but again, it's permanent until the next administration comes in. It can always be changed again. So the idea of having permanent estate tax is probably should be foreign to you because it's not part of our reality. And if any of you wanted to do really good estate planning, you should have passed away in 2010 because there was no estate tax for that 1 year. The fact that you're on this seminar means you didn't do good estate planning. So hopefully we come up with a different plan for you. And that's going to be the good news here in a few minutes, is there is a perfect estate plan for everybody on this call right now. If you're in the ag production business, there is a perfect estate plan that exists. Now, it could be eliminated based on this election. It certainly can be scaled back, but those abilities are available right now. And I always like to tell people, I've heard for years that our taxing system is voluntary, and you've seen lots of cases that have been tried in lower courts and even the Supreme Courts that throw mud in that face because our taxing system is not voluntary. It is required. However, our estate tax system is more voluntary. And what I like to say is people that are educated in the estate tax world do not pay estate tax. And that doesn't matter whether you're worth $5 million, $10 million, or $1 billion. If you're educated in our estate tax system, there is no need to be paying estate tax. The loopholes in our estate tax system are numerous, varied, and will continue to be with us. So President Trump doesn't worry about paying estate tax. His family has done very sophisticated estate tax planning, and their family will not pay estate tax. That's why he doesn't worry about how much the exemption is, and that's why, quite honestly, he wasn't concerned about repealing the estate tax rules. He doesn't have an estate tax problem. And I'm going to tell you in the short time we have together how you cannot have an estate tax problem also. But let's talk about, as we lead up into the election, why the Democrats and Republicans have such different approaches to what the estate tax system could look like after this election. So the Republicans do believe in a high exemption amount, right? Like I said, right now it's 11.5 million. It is scheduled to keep increasing under the general inflation of the country for the next 4 years, and then it will be repealed at the end of 2025 and go back to $5 million adjusted for inflation. So that should put us right around a $6 million exemption for each person once that is repealed by operation of law. We also have another election before that takes place. So even if President Trump wins this election, we could see, before the automatic repeal, we could see another Democratic administration put in place before that could also remove that exemption amount. So not having an estate plan right now, and a very solid one that takes advantage of the current high exemption, is very risky. I highly recommend you develop an estate plan during this year because we still have that high exemption amount. I don't know what the Republicans would do even if they won the House and maintained the Senate. Taxes are going up. The president wants to keep his very low corporate rate of 21%. That means a lot to him because he has a lot of corporations. The estate tax exemption means very little to him. So he would certainly negotiate to lower the exemption in order to keep his 21% tax rate for corporations. So again, the likelihood of the exemption amount moving no matter who wins the election is fairly high, and it certainly is being readjusted in 4 to 5 years. If the Democrats win either the Senate or the White House, you're going to see a lot of pressure to lower that exemption. Because they control the House of Representatives, they can draft bills all day in order to lower that exemption. They may not have the votes in the Senate or in the White House, but with a 51 vote majority only being needed in order to change those rules in the Senate, they could get there pretty quickly, even if they don't control the White House. And then the president would have to certainly negotiate if President Trump is still in office. If Mr. Biden wins, there's going to be a lot of pressure on him as to how much that exemption will be lowered. He is on record of wanting to roll back a lot of the tax rules that were passed in 2017 or took effect in 2017, including the estate tax rules. He's also on record of saying he doesn't want a step up in basis rule and wants to use the Canadian system of estate tax rules. Now, President Trump also said the same thing when he was elected. He said he wanted to use the Canadian system for inheritance and estate tax rules. Then somebody educated him on what that was, and he changed his mind. I would imagine Mr. Biden would also change his mind if he really knew what the Canadian system was, because the Canadian system, when you pass away, the spread between your basis in those assets and the fair market value is taxed right away. And we've never had a system like that in the United States. I don't think anybody other than maybe Bernie Sanders wanted a system like that. But there's going to be pressure on Biden from the Bernie Sanderses, from the more liberal Democrats, to adopt a much lower exemption rate, a much higher tax rate, and probably closing some of the loopholes that we're going to talk about in a few minutes. So when I said that the exemption was $50,000 in 1916, it was based upon 12 times the average household income. Today, they tell us the average household income is about $60,000. 12 times that is $720,000. There are many Democrats that think we should have a $720,000 exemption each. They throw around $1 million, they're comfortable with that, but there's several Democrats that are on record of saying they think it should be that same 12 times, which is 720. I don't know where we're going to end up. Hillary Clinton was on record as saying she wanted to roll it back to 3.5 million. If we all remember, after President Obama allowed it to go to 5 million, he then proposed every year after that to roll it back to 3.5 million because the Republicans started attacking his healthcare system. He thought he had an arrangement, or at least an agreement, that they would let his healthcare system take effect, and then he would allow the estate tax exemption to be at $5 million and then adjusted for inflation. Well, within a month after passing Obamacare, his healthcare system, the South Carolina Attorney General actually took his healthcare system to the state court and asked to overturn that. Kind of made him a little angry, so he decided to try to roll back the estate tax exemption amount to 3.5 million. And so we've had that conflict ever since. So expect that conflict to be integral to the Democratic Party if they do in fact win. And I don't think we're going to have a decision from the Democrats if they do win the House and maybe even take control of the Senate. I don't know how quickly they'll make the income tax rollback their priority. Clearly, it all depends on how much COVID is still spiking or ravaging our country. But certainly, Mr. Biden has proposed getting at increasing tax rates and changing the tax system sooner than later. So I agree with Brian that we'll probably see that certainly play itself out in 2021. And remember, the estate tax rate has always been 55% historically, and as high as 90% under some administrations, including as recently the Kennedy and Johnson administrations in the 60s. So expect those rates to go up, the exemptions to go down if the Democrats win, and expect them still to be negotiated even if the Republicans win. So that's all bad news, I'm sure, for everybody on here if you don't have your estate plan lined up. The good news is there is a plan in place for everybody on this seminar right now. If you are in a small business owner in the ag world, the quickest, smartest thing you can do is first tie up and secure your land base, the main asset of your farming operation. And what I mean by that is have the land in an LLC, LLP, some kind of a limited partnership type entity. And the reason you want to separate the land from the operations is you may want that land to help benefit your heirs going forward, whether that's your children, your grandchildren, your great-grandchildren. But the people that aren't operating the farm, again, they're not all going to be operating the farm. They should not be making decisions with the on-farm heirs because they're going to do nothing but fight eventually. On-farm heirs and off-farm heirs do not have the same priorities. So you have to separate that land from the operations so that that inherent conflict that will eventually happen is separated. But by having that land in that LLC, it is going to be protected for as long as you want it to in an entity that can go on for as long as you want it, depending on which state you're in. And what I mean by that is there's certain trusts out there that then you can put the non-voting interests of that land entity into. So the reason you want to set that up as an LLP is you want most of the interest associated with that entity, your land entity, to be non-voting for several reasons. One, you don't want all of the members having a say in that land entity. As you get it down to the grandchildren and grandchildren, there'll be too many people with too many ideas, too many thoughts, too many votes. But the main reason is those non-voting interests can be discounted. We still allow in our estate tax system for families to discount entities that have restrictions, limited entities. Again, those restrictions will eventually be eliminated. But if you put those in place while they're legal, they cannot be eliminated later on, and I'm going to tell you how. So create an LLC, put your land in it, and then move those non-voting interests into a type of trust that is available in every state that allows you to stay in control during your lifetime, but the assets in that trust are not part of your estate when you pass away. And once you move them in there, any appreciation from here on out is not part of your estate either. So you can move your land into an entity that goes into a trust that is now outside of your estate, outside of your kids' estate, and outside of your grandkids' estate. Not only for estate tax purposes, but for marital purposes and for liability protection purposes. Meaning that if your kids, grandkids get a divorce, your ex-granddaughter-in-law, grandson-in-law, son-in-law cannot get at these assets. No judge has ever ruled that these assets are subject to marital property. And the tax courts have not ruled that they're subject to estate tax property. So this type of intentionally defective trust is the most powerful tax estate planning vehicle out there and is subject to be closed as a loophole at some point. So I highly recommend that everybody on here talk to your specialist, your accountant, your attorney, and learn more about intentionally defective trusts. You can Google it. They're out on the website. They've been around for at least 40 years. The tax courts have sanctioned them. But by making a small gift of these non-voting units into this trust, you get the statute of limitations running right now, meaning that the IRS can only look at your gift tax return for 3 years, and then they can't audit your estate tax return when you pass away. When you pass away, they are going to fight hard if you're over the exemption, because every dollar that they get 40 cents on. That they argue the price is higher, the value is higher, they get 40 cents on the dollar. If you file that gift tax return right now and you make a small gift of these units, remember, everybody on this call has at least $11 million of exemption. So even if the IRS doesn't agree with the discount that you took when you moved them in there, they can't make any money. So the chances of getting audited are about 1%. And if you even get audited, you'll win that audit because the IRS can't get paid now because of the exemption, the huge exemption that we all have right now. If the exemption goes smaller, this strategy doesn't work so well. So you make a small gift of those non-voting units of the LLC into the trust now to get the statute running, and then you sell the rest of those units into the trust. Remember, it's a grantor trust while you're alive, so you're just selling it to yourself. There is no tax implications. But by selling the rest of the units into that trust and taking back a note receivable, you have created a contract under your state law, whether it's Illinois or another state. But because you've created that contract, when the tax laws change in the future, and the estate tax laws will change, they can't undo your estate plan because you have created a contract. And the Supreme Court has not overturned a contract law in any state in over 100 years. And these plans are in every state. So they'd have to overturn all 50 states' contracts law. The chances of that are nil. It's not going to happen. So this is a way of doing estate planning today, taking advantage of the most advantageous estate planning rules, locking it in so that when the estate tax rules and laws continue to change, you don't have to change your plan. And also doing estate planning, not only for yourself, but you're doing estate planning for your kids, your grandkids, up to 100 years in most states. Most states allow these trusts to go on for about 100 years. So you're doing multi-generational estate planning. I can't think of a better estate tax law strategy tool that's out there. And we don't have anything nearly as powerful in the income tax planning world. I am concerned about the income tax planning world because we don't really know, and won't know until after this election, how the next administration is going to treat this CARES money that was distributed. For the most part, it was set up to be non-taxable, but that is not a guarantee. So the buzzwords for the next 2 months is to be very diligent and flexible with your income tax planning and your estate tax planning. You need estate and income tax planning strategies that are flexible because we don't know, none of us know what all the rules are going to be. And you have to stay in touch with your accountant attorney. You have to be diligent about this because they are going to change rapidly. A lot of them probably are going to change late in December, these rules, and some of them won't change until January. And they'll make them retroactive. So we are going to all have to stay diligent and be in touch with our tax practitioner, our tax professional, and even they won't know all of the guidance that is going to be made available to us until probably later in 2021. But we still have to do planning this year. So I know that's a lot to cover in a short amount of time, but I did want to leave some time for questions, so that to the extent that we have any questions out there, Mike, if you're still with us.
Yep, and this is Rachel. I've actually got a question that came in through Q&A. Many young people have a passion to be a farmer or rancher, but they become discouraged because they cannot get access to land and machinery. And it seems that very large farms will do whatever it takes to keep new farmers from getting started. Why shouldn't tax policy be structured to create a more level playing field? Why shouldn't tax structure be structured to create a more level playing field and encourage more Americans to be able to farm?
Good question. Brian, do you want to handle the policy side of that, and then I'll get into the tax policy side of that?
Yes, and I think I would go back to a point I made at the start of the presentation about the importance of being proactive rather than reactive. I think the policy issue that you're raising is a really good one. We should be creating every incentive we can to bring young people into farming, to allow new farms to start, and to ensure that the next generation can make a go of it. Because Lord knows it's a hard business in the best of years, and when you lay on top trade uncertainty or COVID or weather issues, it just gets harder. And so I think that is an issue that we all should work on, and I think Congress would be receptive to that. I think that most people understand, food is a national security issue. It's about our self-reliance, but it's also about America's place feeding the world. And I think there's a huge incentive or a huge interest in making sure that young and new farmers can get a level playing field and get access to equipment, access to capital. And that's one I think we should all work on together.
So this has been a problem for a long time, obviously. This is a generational problem. And there are some programs out there to try to help alleviate it. Farm Credit has some young farmer, new farmer programs to get access to capital. But quite honestly, your parents or somebody's probably gonna have to co-sign on some of that. But there are some programs out there that you can find on the internet. FSA is another problem. I mean, getting set up properly so that you qualify for the farm program payments starting out is very, very difficult. And you can't really just come into your parents' operations unless you're set up perfectly. Now, I will say with the taxing system, all new farmers should pay very little in taxes. The tax code is set up so that young farmers, especially with the ability to write off equipment so quickly, to prepay, there shouldn't be any young farmers out there paying much, if any, tax, to be honest with you. So what we do, because this is not happening quick enough, and so I don't have any magic bullets for you other than everybody's aware of it, but they're not addressing it quick enough, is our firm has certainly worked with families where we know that next generation wants to come in, and we've restructured them so that they are eligible for FSA payments, that they are eligible to get some ownership right away, that they are eligible to not have to have their parents co-sign, and that they can stay in a very low tax bracket for at least the foreseeable future. So there is some restructuring tools that can be done through partnerships. It has to be in a partnership setting. So if we use the partnership strategy and separate land from the operations, because that's the other issue, right? Is if you have everything together, you can never come in. You'll never have enough capital as a 19, 20, 21-year-old, 25-year-old to really buy in and be able to qualify for FSA program payments, or really to be able to get any equity yourself. So the key there in estate planning, as in income tax planning, as in bringing in the next generation, the answer to all of that is separate the land base from the operations and get to partnerships to the extent you can. I know a lot of people that I meet, especially in Illinois and Indiana, have a lot of corporations set up. We can still get there with corporations, but separation is the key. Those separations have to take place first. So I hope that helped answer, but there is a solution. It's not the perfect solution because this problem has existed as long as I've existed. Any other questions? Well, I know we're about out of time. I do want to thank you. I hope you have a better fall than spring, early spring. I've heard great things about harvest in most states, not all, but hopefully you're having a great harvest and you're done by Thanksgiving so you can enjoy that with your family. But I do appreciate your time. Our email addresses have been posted. Feel free to contact us and we can follow up with phone calls. I have been traveling again. I was in 15 states in September, so we are getting out. I love to see operations. I love to sit down with people and understand what their operation exists and what the goals of they are. So feel free to reach out to us. And Brian, I'll let you close.
Well, thank you, Kevin. And again, thank you to Illinois Soybean for the opportunity to talk today. And let's definitely treat this as the start of a longer conversation or start of a lot of additional conversations, because whether we're talking about advocating for the interests of Illinois soybean in partnership with Illinois Soybean Association, or talking about discrete, estate plans and succession plans like Kevin talked about, there's no shortage of work that we need to do together to make sure that we're making these farms as profitable as they can be, and setting you up to be able to pass your estate on to the next generation. So again, Mike and Illinois Farm Bureau team, thank you for the opportunity to be here today, and we look forward to continuing to work with you.
Very good, and thank you, and we truly appreciate it. Appreciate the time, and we wish everybody continued success out there with harvest, and everybody to remain safe. And again, we'll urge everybody to please vote if they have not already done so. Thank you.
Thanks, everyone.
Take care.